Hey guys, it's Sunmin and welcome back to Your Money Game, the show where you'll find out how to get better with money by saving, spending, and investing better. Today's video is made for those of you who are interested in getting started in the stock market, or those of you who have kind of dabbled a little bit but haven't really found your groove yet. My goal is to give you a guided tour of all the different options that you have, and trust me, there are quite a few. What are the implications behind some of those options? And then give you additional resources and leads on where you can do more research in. Before I begin, there are three simple caveats that I like to get out of the way. The first is that when you think about money for investing, it should be money that you're able to afford to invest for the long term or that you can afford to lose. So one useful way to think about it is that this is money for your stock market education and that you don't really need it in the very short term. The second point is that with all the different approaches to stock market investing, you can imagine that some people will have very strong opinions on which approach is the right approach, including me. My goal for this video is not to discuss which approach is the best approach, so find that elsewhere. Finally, one of the key ways I'll be explaining my point is to use the language of betting. And the intent behind that isn't to imply that this is a gamble, but it's just a simpler way for me to get across a point that I think is important for you to understand. So the first question you want to ask yourself when picking a stock investing approach that fits you is how involved do you want to be? So what I mean by involvement is how much interest and how much effort do you want to put into the act of being involved with your investments. For the sake of simplicity, there's low involvement and there's high involvement. So let's start with low involvement. Now, option one under low involvement is something that you might already be doing, which is trust a guy or a girl that you know in investing. What they do is they sit down and figure out your wants, assess your needs, and then outline a plan for you that's usually holistic in the sense that it might include insurance products, but it will also include different investment type products. Another option of trusting a professional is to look for what you call a fee-based advisor. Fee-based advisors tend to market themselves as impartial because they're taking a fee and not a commission. So of course, commission-based advisors tend to argue that that doesn't necessarily mean they're better, and they're right. Nevertheless, you still have to make a decision of who do you really want to trust. So what you're really betting on here when it comes to your investments is the trust that you have in this person. Secondly, the trust in the manager of the funds that he's selling you and that it's going to perform in the long term. And you're trusting that the fees are fair. I'll be touching some links below so you can read a bit more about these type of advisors as well as the impact of fees. Low involvement option number two is the new kid on the block, and they're called robo-advisors. What they're promising you is that we will help you get started in investing very easily, usually at a low entry fee as well, so you don't have to fork out so much when you start. They'll help you build that portfolio by assessing your risk, and then they'll help you manage it and automate the entire process. All that is done for you at what they term as a small and reasonable price. So with robo-advisors, because they're still relatively new, what you're really betting on here is that the algorithms that they have to manage your risk are adequate and they perform as promised. You're also trusting that the few questions that they've asked you really creates a portfolio that suits your risk profile. And finally, you're trusting that the fees are reasonable enough that it doesn't completely eat away the returns that you want. I've got a couple of links below that give you a more detailed overview of robo-advisors, and on top of that, one more industry overview. Now, the third low involvement option is to do it yourself. Now, I know that DIY doesn't sound like it's low involvement, but there are ways. And within DIY, there are a couple of approaches as well. So with DIY, option A is to build a portfolio of different sectors. And you can do so by using different type of ETFs or exchange traded funds. Basically, they're just a collection of different stocks that you can buy from the stock market. Or you can also use unit trusts to create this strategy. And what sectors tend to be is, for example, healthcare, biotechnology, oil and gas. So again, what you're doing is you're trying to build a portfolio of different sectors that you think are going to perform well, and then switching in and out of those sectors depending on where you think the economy is going. And this entire approach is called sector rotation. So what you're betting on here is your ability to choose the right sectors that are going to be growing, building a diverse enough portfolio of different sectors, while entire industries or sectors tend to move a little bit slowly. Nevertheless, you still need to put in a bit of effort to manage that portfolio. I've attached a link below for you to read more about sector rotation. DIY option B is where you're deciding to choose different countries and different assets. So in a nutshell, this is really you trying to replicate what the robo-advisors are doing for a much lower fee. So the approach can be summarized as low-cost index investing. So by taking this approach, what you're usually doing is betting on a very large segment of the country or of a very large theme. For example, with the Russell 2000, it's what you call small cap stocks. Or with the Nasdaq, it is very broadly tech stocks. So what you're also betting on here is your ability to build your own diversified portfolio of different kind of asset classes so that you manage your risk in the long term. So I've created a video of that before, so you can kind of dig into that if you want to learn more. So again, below, there's going to be a lot of links for you to read up on index investing. Another thing that's DIY and low effort is for you to click that like, subscribe and bell button, because that really helps me out. So now that we've covered the low involvement, let's move into the high involvement options. And this is where you usually want to get your hands dirty in figuring out and choosing your own stocks. So option 1 in high involvement is when you really feel that the clues are buried within the financial data or economic data. If your answer is yes, you will be focusing on what you call fundamental analysis. A useful way to think about this is to think of yourself as an investigator, and what you're doing is you're looking for clues to help you figure out what the worth of a stock is. But there are 3 very popular approaches to do so. First approach is what you call value investing. Under value investing, what you're trying to do is to analyze the financial data of a company, understand the worth, and if the price is low relative to what the value is, you have a gap. So what you're trying to do is to take advantage of that gap because you're buying it at very deep value. The second approach is called growth investing, an approach where you are trying to figure out which company you feel has a large or strong potential of growth. So your analysis might favor the growth of earnings, it might favor the growth of customer base, it might favor the investments in different kind of technologies. So either way, you're trying to analyze data to figure out whether or not the potential for this company to grow is really there. The last popular approach is what you call dividend investing. So dividend investors tend to look for these type of companies because they pay out a high proportion of their profits to an investor. What makes this approach attractive is that it's money in your hands as a shareholder, so hey, that feels really good. So with this approach, you're betting on a few things. The first is your ability to analyze all that financial data to figure out what you determine is the worth of a company. The second is to build a portfolio of a few of these companies to diversify your risk. The third thing is that over time, you're going to be building and refining upon that system or checklist of what determines a valuable company. And depending on your time horizon, you're also betting on your ability to keep tabs on all the different companies that you own. Again, links below for further reading. Now, the final option for you to consider is high involvement, but you believe that the clues are actually in the price and in the volume. So what you're doing is you're watching the prices to understand where the market is trying to go. And this approach is broadly called technical analysis. With technical analysis, what you're looking at are stock charts, the different patterns of prices, what different indicators are telling you, and then using all that information to try and figure out where you think the stock price is going to go. Broadly, they can be split into different time horizons. The first time horizon is what you call day trading. And as the name implies, it's usually you making a buy and sell decision within the same day. The second is what you call swing trading, and that involves you making a trade for multiple days or even multiple weeks. And traders that are doing it for the longer term are called trend following traders. Regardless of the time horizon, you're actually betting on a few things here. The first is that you're betting on your ability to read the stock charts and the different indicators to understand what they're trying to tell you. The second is you're betting on your ability to build a system of using multiple kind of indicators to tell you when should you buy and sell. The third is your ability to practice very strong risk management. With trading, it tends to be higher risk, so you really need to be extra careful. The fourth is your ability to execute on your system, because it's one thing to build it, but it's another thing altogether to follow it consistently over a long period. And finally, because this approach tends to have a higher amount of trades, you also need to be aware of the different transaction costs involved. I've attached a link below for you to read more about the difference between fundamental analysis and technical analysis. But I want to leave you with a few universal points which I think are important. The first is that regardless of which approach that you choose, it's not just choosing it, but it's the ability to execute on that approach. The second thing is that being aware of your risk appetite is one thing, but you can only figure it out once you're in the markets. Because thinking about it intellectually is one thing, experiencing, feeling the losses, that's a whole other game altogether. In reality, most people will blend a few different styles together. So for example, some people might use fundamental analysis to figure out the worth of a company, but use stock charts to help them make a buy or sell decision. Final point is that it takes time to figure things out for yourself. Even if you choose to trust a guy or girl, one day if you wake up and you realize that you're not very happy with the results, what it'll cost you is time. If you decide to embark on a do-it-yourself adventure, guess what? It takes time to figure it out as well. Regardless of which strategy or approach that you pick, it needs a little bit of time for you to be comfortable with it, but ultimately, if you take charge and you play your own game and you build your own system, you're gonna come out a winner in the long term. So if you've gotten any value out of this, I'd really appreciate a like, subscribe, and click that bell button as well, because I'll be back again next Sunday. And until then, keep playing your own game.